Hey now, Eric Sabatini, mortgage agent, back with your Monday mortgage scoop for today. A very, very hot topic these days seems to be the blend and extend, or what I like to call the extend and pretend game that some Canadian banks have been playing. So basically, if we extend the amortization of our clients' mortgages, okay, we can pretend that everything is just fine or dandy, all right? And that's what some of the banks have been doing. And I wanted to bring your attention to it, okay? So over the last couple weeks, we've seen a large data dump from Canadian banks in their latest quarterly earnings. Now, I don't expect you to know all of that stuff or even care about it, but what I bring to your attention is this important feature because it's important for everyone in the financing process or journey to know exactly how specific mortgage products work, okay? And why buyers require a mortgage agent, not just a bank advisor from their branch, to explain the ins and outs of the short-term and long-term consequences. And I don't mean consequences in necessarily negative ways. I mean positive and negative, okay? So I want you to check out this chart, okay? And I'll show it to you again in a second. But this chart highlights the differences between variable and adjustable rate mortgages. It also highlights what impact these different mortgages can have on one's future financial freedom. So to review, there's two types of variable rate mortgages out there. A variable rate with a static payment and a variable rate with adjustable payments, okay? As you're aware, prime has gone up nearly a dozen times over the last 12 plus months. With a variable rate with static payments, one's mortgage payment doesn't actually change. Rather, what the lender does is they just rebalance how much of that monthly payment goes towards principal and how much goes towards interest. So when prime goes up, they take a little bit less from principal and they tack it on to interest. So you're paying more interest. All right. This product has positives and negatives. One positive, it makes it easier for clients to budget because their payments don't change. But the negative, this chart is going to show you. With adjustable rate mortgages, every time prime goes up or down, monthly payments change with it. Now, one of the downsides is it makes it harder to budget because as we've seen over the last year, this can lead to a lot of short-term pain for clients when prime consistently goes up and therefore their payments consistently go up. But there is one major positive with this, okay? Look at these numbers. Look at TD, RBC, BMO, CIBC. They have an amortization problem and it's because of their mortgage products. I am particularly worried about the percentage of borrowers over 35 years amortization. This is going to be life altering for a good chunk of society. When you take amortization from 20 years and you bring it over 35 years, it means you're adding on an additional 15 plus years of mortgage payments. TD, RBC, BMO, CIBC, they have a variable rate with static payments. Prime has gone up so many times that clients' monthly payments are no longer enough to cover the principal and interest. Instead, all right, what's happening, instead of clients increasing their monthly payments, what the banks have done is they've just been extending their amortization beyond 35 years even. So when a client goes to renew their mortgage, they're actually going to owe more as they're not paying anything towards principal and interest now, okay? And they're going to be further away from paying off that mortgage than when they first started their term with those lenders. Now, the issue with this is that the money that's now going to be going towards their mortgage is not going to be going towards things like their child's education, towards RSPs, towards retirement funds or TFSAs. This means that we could potentially see the aftershocks of the last 2 years of increasing rates for potentially 50 plus years into the future. Okay? Now, of course, there is an outlier on this chart. All right? I want you to look at Scotiabank. Scotiabank seems to have found a way to control the amortization problem. Why? They offer a different variable rate product. They offer adjustable rate mortgages. So every time prime increases or decreases, Scotia automatically adjusts the payments accordingly. This is obviously a negative or has caused pain for some borrowers now, but it could save their financial life from ruin in the next 10, 15, 25, 40 years. These borrowers are forced to keep up with their principal and interest payments and are not compromising a thing, not one thing when their term matures, okay? Not like those with the variable rate and static payments who now have to deal with increased balances and longer amortizations. Now, on a side note, okay, Scotiabank is my preferred lender and the 1A lender I do the most amount of my volume with, and it's always been because of this, all right? So what's the takeaway for you? Product knowledge, expertise, future forward thinking. Listen, I use all of the lenders discussed in this video, and everyone's situation is unique. But when this rate increase environment calms down and rates normalize, the large majority of my book of business will be coming out of things still on track in their financial future. And why? Because from day one, we discussed the differences between adjustable rates and variable rates with static payments. All right. And these clients were educated that long-term thinking will always trump short-term bandages. And they knew from the start that if they could handle the short-term pain of increasing payments, they wouldn't be forced to compromise their financial future. Anyone, and I mean anybody, can get you a mortgage or a good mortgage rate. I've never sold in my business on rate alone, and this chart is now my golden nugget. A mortgage and a mortgage agent is the most important person in the financing process because your future financial health depends on it. Happy selling.